Please. Gita, good morning, and thank you so much for joining us. We're really thrilled to have you with us. Let's start just kind of with an outlook of where the world is right now in the global economy. Are we in a good place, a bad place, and kind of maybe start with kind of global inflation outlook. What's your sense of where we are?
Yeah, so Clay, firstly, thank you. Thank you for having me. The outlook, I mean, the best way for us to describe it is that we've seen a global economy that has been resilient.
Yeah.
In a way that we haven't seen before. So let me explain. We've had a global economy the last 4 years that's been hit by a pandemic, an energy crisis, inflation that shot up, and central banks everywhere raised interest rates by a lot. Usually in the past, if you have these kinds of knocks, you would see a more prolonged global recession, you would see some sort of an emerging market sovereign debt crisis, and we did not see that. So I think that's the first thing we should recognize, is that this is a world that has been resilient. And now, some parts more than others. The US really does stand out, is doing extremely well. Europe less so. China still with weak demand, but still, again, resilience. And resilience doesn't mean that everything is great. Resilience is coming along with kind of a weak growth outlook. So growth is expected to be around 3.2% this year and next, settles around 3% 5 years out. That's not a bad number, but if you compare that to historical averages over the last 2 decades, it used to be around 3.8%. So it's coming down. So growth is coming down, but you have resilience. And in terms of inflation, since you asked about inflation, again, inflation went up almost uniformly in all parts of the world, has come down by a lot, and our forecast is for inflation to return to central bank targets by next year in pretty much all the major economies of the world. So we see that coming down, and like I said, that has all happened without there being a big hit to economic activity, to labor markets are still strong in many parts of the world. This is not how it was in the 1970s when we had the previous episode of very high inflation and inflation came down. Those were marked with deep recessions, big increases in unemployment rates. That's not been the case this time.
That's remarkable. So what I hear you saying is that, relative to coming out of crises historically, that we're actually doing pretty well. And yet that seems not necessarily to be reflected, at least in the democratic countries, and some of the political outcomes that we've seen, which is interesting. Let's talk about debt a little bit, because that's another thing that the fund covers follows very closely. I think the fund has noted that global public debt levels will exceed 100 trillion, about 93% of global GDP by the end of this year. Is that something we should worry about, or is that still something that's an okay ratio?
Yeah. I mean, just to start with the point you previously made about why is it that people haven't felt the resilience and strength. 2 reasons. I'm making a comparison to how bad things could have been.
Right, I see.
And in that sense, things were more resilient. But then the second fact is inflation did go up, which means prices went up by a lot. Inflation rates came down, which means prices are continuing to go up, but at a slower pace.
Right.
So if you look over a 4-year period, you have seen households who looked at how much they're paying for their goods that they bought in the past and said, well, everything is a lot more expensive. So it's not surprising, the way people feel versus the way I'm describing how the global economy is. In terms of debt, yes, I think this is, at the International Monetary Fund, we pay very close attention to debt build up in different parts of the world. This year, we expect by the end of this year, debt around the world will be about $100 trillion. Those are very large numbers. As a share of global GDP, we're getting close to post-World War II peaks. So this is a high debt world. Now, some of this was, of course, a reflection of the build-up that happened during the pandemic and governments trying to support their populations. That build-up did come about. But interest rates have also gone up. So what we are seeing are 2 sets of issues. So again, you could ask, does this mean that we're heading for now a debt crisis? Is there going to be a debt crisis? No, we don't see that. So even if you look at the group of low-income countries, it's not as if we're seeing our projection is for many of these countries to see themselves in default. That's not where we are. There are some, but not the biggest, not the large number. The bigger concern is more liquidity.
Right.
So if you take the numbers for low-income countries, next year, this year and next year, they have about $40 billion that they have to refinance. Now, if the market provides that easily at fairly affordable rates, that will be manageable. If it doesn't, then in that case, you could see much more debt distress.
Interesting. So again, it's a pretty positive outlook, though, a message in terms of where we are relative to where we might have been. So I find that quite encouraging. I want to ask you about something you may not be able to completely answer, but there's been a lot of talk here yesterday about the prospect that the largest economy in the world is about to sort of embark on this program that involves a lot of tariffs, whether they're tariffs on China in particular, or whether it's tariffs across the board on all of its trading partners. And I know that the IMF has done a lot of research on the impact of tariffs previously and has warned that tariffs are bad for everybody, and relative to open trade flows, that's much better. To what extent do you see sort of the IMF's role in warning people about the implications of another round of tariffs? And how much can you say or not say about what the likely consequences of a very expansive tariff program might be?
Yeah. No, firstly, I think we all recognize, and that's in the data, that global economic integration through trade and capital flows has been very helpful for the world in terms of raising hundreds of millions out of poverty, but more generally in having prosperity in many parts of the world. Now, I can't speak to what will come next in terms of what the actual trade policies will be, because the honest answer is, I don't know at this point. We have to wait. Once the policy announcements happen, then we will analyze the consequences of that. What I can point to, basically looking at the last 2 or 3 years, is that there has been a shift, a very important shift in the way economies see integration. And there are good reasons for it. In the past, countries and businesses were hyper-focused on efficiency, which is you bought from wherever the cheapest source was. And then you had the pandemic when supply chains broke down, and you have Russia's invasion of Ukraine, and Germany getting shut out from gas supplies. And so countries are now saying, well, efficiency alone won't do it. You need to be able to have resilience in your supply chains, and that's a perfectly legitimate argument to make. In addition to that, of course, countries worry about that some of their trading partners have long-standing subsidies and have provided a lot of support to their industries, and that creates an unfair playing field, right? Not a level playing field. So what are we seeing, if you look at the data over the last few years, is that unlike the past, and I would say, since the Cold War, we haven't seen patterns of this kind, is that we're seeing much more of global trade and foreign direct investment that is driven by that is affected by geopolitical factors.
Right.
So trade between countries that are more geopolitically aligned is holding up much better than trade across countries that are not geopolitically aligned. And so we're seeing those shifts. Like I said, some of that makes sense, but we have to see what the actual policies are to see how big of a shift this will be.
Really interesting. So I guess my question to you is, if we shift further into this world that you're describing that's more fragmented on kind of geopolitical lines, and so instead of this open global system where everyone trades with everyone more or less, we kind of split apart into these blocks, whether they're regional or whether they're kind of superpower blocks. Can the global economy maintain the relatively stable growth and resilience that you've described that it has right now? Is it able to preserve that, or does it put it at risk?
Well, again, without knowing the actual policies, it's hard to speculate on the extent of what the impact would be. But we have, of course, simulated scenarios in the past about what could happen if you had very deep breakdowns and if you have a decoupling in the world. And the costs can be quite substantial. It's not one of those minor events.
Right.
Those would be very substantial. On the other hand, if it is done well and it's well managed, the cost could be relatively small, so it could be as low as 0.2% of GDP. So again, a lot depends on how it is managed.
Yeah, interesting. Paul Krugman's got a little audio snippet on the New York Times website this morning where he declares that the Trump package of initiatives is the most inflationary package of proposals that any president in the history of the U.S. has ever put forward, which is quite a statement, and he goes through point by point by point why that's so. Just as a general rule, though, is it correct to conclude that high tariffs in general tend to be inflationary?
So again, we need to know how exactly the tariffs work. But if you take the example of what happened in 2018-19, the tariffs that were put in terms of what the impact was, for example, on the US economy. So yes, it was a cost push in the sense that it made it more expensive for US firms that were buying those inputs.
Right.
But the pass-through of that from there to consumer prices was not that big.
I see.
So that was not the case. But again, the details matter in terms of what goods you put the tariff on, how widespread it is, whether there are substitute sources from where you can get the product. So all of those details matter for what the precise impact is going to be.
Okay. Let me shift gears a bit and ask you about a topic that came up a lot yesterday and will again today, and that's AI. We've heard a lot about how AI can improve our productivity, where it can accelerate scientific breakthroughs. Many positive, promising things will come out of it. There's also a concern about what it means, though, for jobs. And you've made some very interesting observations about how AI may possibly have unexpected interactive effects with the macroeconomic cycle. Can you say a little bit more about that? Because I thought your comments were really fascinating.
Sure. So again, going back to where we started in terms of the global economy, I pointed to the fact that growth, while holding up, it's not a good number. We would like that growth to be higher. And one of the main factors that can raise that is if we can raise productivity growth, because that's what slowed over the last 2 decades. And so in that sense, this new technology, generative AI, and its new forms of it sounds exciting. It's like, okay, well, maybe this is something that can actually raise productivity. And we've simulated what the effects could be. We can see that, say, 5 years out, growth could be higher by around 10 basis points or 80 basis points. Now, if you're looking at a baseline of growth of 3%, if you have an 80 basis point increase, that's a pretty strong effect. But there's a range, and it's not very clear how effective it would be. It depends upon how quickly it is being adopted. So there's a lot of promise that comes with AI. It's going to depend upon how quickly it's adapted. Now, you were pointing to this piece that I put out, which is that there's something very interesting in the way technology affects the business cycle. Technology has huge amounts of productivity effects, but also does have an effect on the labor market. Now, the extent to which that happens varies depending on the technology. Our estimates are about 40% of labor in the world is exposed to AI. That doesn't mean it's a bad thing. About half of those can positively benefit from it, and half of those will be, they could be negatively impacted from it. Now, that is a challenge. And what we've seen in the past is that when do you actually see the effect of new technology on the labor market? And what we've seen from previous cycles of technology booms is that it doesn't happen in good times. So when you have good times and companies are making lots of profits, they hold on to workers, they're investing in the technology, but they're holding on to workers. So you see it when the recession strikes. That's when you really see the effect of automation on the labor market. And that's what we saw, for example, after the great financial crisis. If you remember, we all talked about jobless recoveries for a long time. And that jobless recovery was a reflection of finally companies letting go of workers, fully automating the task, and not hiring those workers back. So that's when you see it. So the caution here is for policymakers, which is to say, just because you're not seeing it now when things are good, that doesn't mean that you will not have an abrupt shift in a recession.
Very interesting. I want to ask you, if I can, also about China, second largest economy, very important to global trade flows. We spoke yesterday on a panel that was all about China, trying to assess where China's macroeconomic outlook might be. Last week, they introduced a $1.4 trillion stimulus program. It hasn't seemed to really impress markets too much. What's your assessment of China's economy, its prospects, and particularly what its structural challenges might be?
Yep. So again, China, the second largest economy of the world, we would expect the growth in China not to be 10%. We expect it to go down. Mm-hmm. We have it this year for about 4.8% and going down slightly next year. In the case of China, the main constraining factor is that domestic demand, especially consumption, is weak. Household consumption is weak in China, and you have more deflationary dynamics than in other parts of the world. The property market is a big issue. It's been a problem for a couple of years. Part of this is the government trying to moderate the size of the property market. But we haven't seen a positive turnaround. So I think the important thing is the government is moving and putting a lot of measures in place. For us, for there to be a big effect on growth in China, we see the need for policies that are more directed to households. And that is not the case as of now in a lot of the policies they've announced. But that's what's going to be needed to be able to raise consumption so they're less dependent on exports to the rest of the world and more dependent on domestic demand.
Fascinating. Certainly no shortage of things for the IMF to keep track of and monitor as we move forward over the next few years. Gita, I want to thank you so much for being with us this morning.
Thank you.
Thank you.